Hello, everyone, and welcome back to the Deep Dive. I hope you're having a fantastic week and are ready for another, deep dive into the heart of a truly fascinating business. Today, we're focusing our lens on one of the most compelling stories in the pharmaceutical world, Eli Lilly and Company. This is a company that has captured a tremendous amount of attention and for a very good reason. On the surface, it looks like a quintessential wonderful business, boasting incredible momentum in a seemingly unshakable competitive position. But the real question for us and for you as we unpack this today is this. Does its current premium valuation leave any room for error, even for a company of this caliber? Or is this truly a rare generational opportunity worth paying up for? That's what we're here to find out by digging deep into, every facet of Eli Lilly.
Yeah, it's fascinating, isn't it? Because what we're looking at here is this convergence of a powerful long-term secular trend and a company that finds itself not just participating in it, but standing at the absolute forefront, effectively shaping that trend. The challenge, as it always is with businesses of this quality, is understanding not just the underlying strength of the company itself, but what that inherent quality and, that future potential, what it commands in the market. It's a complex puzzle when a company's prospects are so widely recognized, yet the future still holds such immense, almost unprecedented potential.
All right, let's unpack this from the ground up then. When we talk about Eli Lilly's incredible growth, how exactly are they generating it? And what makes them fundamentally different from, say, just another large pharmaceutical company? Because, when you look closely, there's a unique approach here, right?
Yeah, absolutely. Eli Lilly is far more than just another pharmaceutical company. It's arguably one of the most effective, high-quality compounding machines operating today. What they've done with truly masterful execution is identify and then brilliantly surf, you could say, a massive, long-duration secular tailwind. We're talking about the fundamental revolution happening in metabolic disease treatment, specifically in diabetes and obesity. Think of it like Charlie Munger's surfing mental model, finding that huge, powerful wave, in this case, a societal shift towards understanding and treating chronic metabolic conditions and positioning yourself right on its crest. But Lilly hasn't just caught this wave. They've become a principal force shaping its very direction and magnitude. It's a wave that promises to carry them forward with significant force for years, perhaps even decades. It creates this self-reinforcing cycle of innovation and market leadership.
And the undisputed engine of this, the very heart of the wave we're talking about, is what's been dubbed the Incretin revolution. So let's talk about the stars of this revolution. Mounjaro, which is tirzepatide for type 2 diabetes, and Zepbound, the exact same compound, but for obesity. Why are these considered such a fundamental paradigm shift? Not just, incremental improvement. It feels like something much bigger.
You're absolutely right. This is not incremental at all. These molecules, particularly tirzepatide, represent a fundamental paradigm shift, a whole new way we approach and treat metabolic diseases like type 2 diabetes and obesity. Previous treatments, they primarily focused on managing symptoms or achieving modest weight loss, sort of tinkering around the edges. In contrast, incretins, which are gut hormones, they fundamentally alter the body's metabolic signaling. GLP-1, glucagon-like peptide 1 is one. GIP, glucose-dependent insulinotropic polypeptide, is another. Lilly's tirzepatide is a dual agonist. It activates both GLP-1 and GIP receptors, and this dual action appears to offer superior efficacy compared to GLP-1 alone, leading to not just exceptional blood sugar control in diabetics, but unprecedented levels of weight loss in individuals with obesity. This isn't just about reducing a symptom, it's about fundamentally changing the body's metabolic landscape. That's why it's so transformative.
Wow. Okay.
And the market's response. As you can imagine, it's been nothing short of explosive. In the second quarter of 2025, Lilly's total revenue surged by an astounding 38% to $15.56 billion.
38%.
Yeah. And the vast majority of that growth, specifically 42% of it, was driven by volume increases, overwhelmingly from Mounjaro and Zepbound. To put that into perspective, Mounjaro sales alone grew a staggering 68%.
68.
To $5.20 billion in that single quarter. And Zepbound, their obesity drug, which is still pretty new, relatively speaking, reached $3.38 billion.
Just incredible numbers.
These aren't just big numbers. They demonstrate that Lilly isn't just participating in a trend. They are actively driving and defining a new standard of care. They're essentially expanding the market even as they capture it.
That's truly incredible. The scale is almost hard to grasp. But for any investor, a crucial question always comes up. Is this amazing growth story entirely dependent on these incretins, or is there a significant diversification in Lilly's broader portfolio? Is it a one-trick pony, even if it's a really, really good trick?
Right, that's a fair question. And if we connect this to the bigger picture, you actually see a crucial and often overlooked layer of diversification. It adds significant stability to Lilly's growth profile. While the Incretin franchise is undeniably the primary engine right now, Lilly's non-Incretin portfolio actually delivered robust 20% growth in the fourth quarter of 2024.
20%, that's still huge on its own.
Exactly. That's a very significant contribution from other established franchises, showing real breadth of strength. We're talking about products like Verzenio, their oncology drug for advanced breast cancer. It saw sales of $5.3 billion in 2024. That's a substantial 37.4% increase year over year.
In oncology, a tough market.
Right, a very important high-value segment.
Yeah.
Then there's the Jardiance family of diabetes products. They co-market those with Boehringer Ingelheim. Generated a formidable $12.4 billion in 2024, up 15%.
Wow, $12 billion.
Yeah, Jardiance is a well-established, highly effective SGLT2 inhibitor. Approved for type 2 diabetes, heart failure, chronic kidney disease, speaks to its versatility. So this diversification provides a critical layer of stability and resilience. It means Lilly has multiple established avenues for growth, not solely relying on the incretins, which allows them to, weather potential shifts in the competitive or regulatory landscape for any single drug class.
And what does this powerful momentum seen across both the blockbusters and the diversified portfolio suggest for their future trajectory? Are we looking at a sustained period of this kind of accelerating growth, or is this more like a peak?
Well, all signs, both qualitative and quantitative, really point to continued powerful momentum, for the foreseeable future anyway. For the full fiscal year 2024, pharmaceutical product revenue was over 90% of their total, growing at an astonishing 41.4% year over year to reach $40.75 billion.
40% growth on that base.
It's truly remarkable growth at that scale. And looking forward, the company's own guidance for fiscal 2025, they project revenue between $60 billion and $62 billion. 60 to 62.
Right. At the midpoint, that's roughly 35% year-over-year growth. These aren't small numbers for any company, let alone one already doing tens of billions in sales. It indicates management fully expects to ride this wave with significant force. Fueled by both expanding Incretin sales and continued strength from their diversified portfolio, it points to a very strong growth runway for the next several years.
Okay, here's where it gets really interesting for me. Warren Buffett often talks about durable competitive advantages showing up directly in superior financial performance, high returns on capital, clear pricing power. How does Lilly's financial profile fit this description for you? Does it truly scream wonderful company from the balance sheet?
Oh, it absolutely does, and in a way that truly exemplifies the traits Buffett looks for. Lilly's financials are, well, a masterclass in how a truly great business operates. You see exceptional profitability and superior returns on capital. Those are the hallmarks, right?
Right.
Let's start with profitability. Q2 2025, their gross margin hit an impressive 84.3% reported. Even higher non-GAAP, 85.0%. 85% gross margin.
Yeah. It's not just high for any industry, it's particularly remarkable in a capital-intensive business like pharma. And what's more, this margin is actually expanding, driven by that favorable product mix selling more of the high-margin drugs like Mounjaro and Zepbound, and at the same time, improving production costs, even while they're doing this massive manufacturing scale-up. This directly indicates immense pricing power. They make highly valued products that command premium prices, and they do it with exceptional cost control.
Okay, that's pricing power. What about returns on capital?
That's perhaps the clearest financial sign of a moat. Lilly's return on invested capital, ROIC. For the 12 months ending June 2025, it stood at a remarkable 40.6%.
40% ROIC.
Yeah. Think about that. For every dollar they invest back into the business, they're generating over 40 cents in profit. It's incredibly efficient use of capital, and it vastly exceeds their estimated cost of capital, which Morningstar puts around, say, 7.3%. That spread between ROIC and cost of capital. That's the true value creation for shareholders.
Huge spread.
And it's not a fluke. Their 5-year average ROIC is a robust 30.2%. Shows sustained, high-quality performance over time. Finally, they maintain robust financial health. Management's very strategic with the capital structure. As of year-end 2024, assets $78.7 billion, liabilities $64.4 billion, long-term debt $33.6 billion. But their position is getting even stronger. Morningstar projects their debt-to-EBITDA ratio will fall below 1.0x by 2025.
Wow, below 1.
That indicates very low financial risk, risk, gives them tremendous flexibility, strong resources for future reinvestment. Even with all the manufacturing expansion, it provides optionality and resilience.
So those financial statements paint a picture of a truly exceptional business. But numbers, important as they are, only tell part of the story, right? The customer's experience, what patients are actually saying.
Yeah.
That often tells a more predictive, maybe more human story. What are patients saying about Lilly's key drugs, and why should you, our listener, care about these personal stories?
That's precisely where you see the real Lollapalooza effect, as Munger would call it. When you dive into patient reviews, testimonials, you uncover this powerful confluence of positive factors. Creates an outcome greater than the sum of its parts. It's really compelling to hear these stories.
So let's start with Mounjaro and Zepbound. What's a patient experience like there?
It's frankly extraordinary. Reviews are overwhelmingly positive. Users frequently use superlatives. Life-changing, a miracle, fantastic. The reported efficacy is dramatic. You hear users citing significant, rapid weight loss they could never achieve before. Phrases like, 4 stone down in 6 months, 7 pounds in my first 5 days.
Wow.
But what's critically important here, and something financial models often miss, is the profound psychological benefit. Users report a dramatic reduction in constant food cravings, that pervasive food noise that plagues people dealing with chronic obesity, a complete reorientation of their relationship with food. People talk about feeling normal around food for the first time.
That's huge.
It is, and many praise the user-friendly QuickPen injection device too. Makes it simple. Now, gastrointestinal side effects like nausea are reported, we should acknowledge that, but they're often described as manageable, temporary, and a completely worthwhile trade-off for the transformative benefits. Imagine struggling for decades, trying everything, then finding something that fundamentally changes your relationship with food and your body. That's a powerful connection.
That's a really powerful endorsement. Vivid picture. How does that compare to their oncology drug, Verzenio? The stakes there are obviously quite different.
Right. For Verzenio, the patient experience is different naturally, given the disease, but the efficacy is clearly recognized and highly valued. Patients credit it with extending lives for years, dramatically shrinking tumors. We've seen reports, a stage 4 breast cancer patient saying the drug has kept me alive for 5 years, well beyond prognosis. But it's equally important to acknowledge the side effects are significant, often severe. We're talking chronic diarrhea, debilitating fatigue, nausea, even brain fog. So this naturally leads to lower overall satisfaction scores on some platforms. People weigh the benefit against the daily struggle. It highlights those difficult trade-offs in life-threatening diseases. Very different dynamic from Mounjaro or Zepbound, where the trade-off often feels much more favorable.
Makes sense. And what about Trulicity for diabetes? Similar story to Mounjaro.
Very much so. Trulicity, a GLP-1 agonist, is often described as a lifesaver by type 2 diabetes patients. Users report remarkable improvements in A1C levels, key measure of blood sugar control, like a drop from 12.7 to 5.5, excellent management.
Big improvement.
Huge. And alongside this, they often get beneficial weight loss, though generally less than Mounjaro. Side effects are noted, similar to Mounjaro, but patients frequently report they subside after the initial weeks. Makes it a highly valued, well-tolerated long-term therapy. Another clear example of a Lilly product providing substantial, durable benefits.
So what are these deeply personal patient stories across these key franchises? Tell us about Lilly's competitive advantages for your long-term investment horizon. This goes beyond spreadsheets, right?
This raises a truly important question, because the profound, often euphoric language used for Mounjaro and Zepbound, and the durable, life-improving impact of drugs like Verzenio and Trulicity, it points to products delivering value far exceeding just medical efficacy. For many, it's a fundamental, life-altering change. Quality of life, health, self-perception, and this overwhelming positive experience translates directly into several powerful components of a durable economic moat, critical for long-term investment.
Okay, like what specifically?
First, it builds an incredibly powerful brand, synonymous with tangible, life-altering results, earn trust. Second, it creates extremely high switching costs.
Well, if you've lost 50 pounds.
Exactly. Imagine that patient, feeling better than ever thanks to Zepbound. They are highly unlikely to switch to a competitor, even for a modest price advantage. The perceived cost of switching, losing efficacy, new side effects, regaining weight, it's just too high. This dynamic creates a powerful pull in the market. Patients actively seek these meds, share success stories, advocate for them,
word-of-mouth effect.
Huge word of mouth. This groundswell influences doctors, pressures payers for coverage. It reinforces Lilly's market position way beyond just patent protection. It's a critical qualitative force that financial models often struggle to capture, but it's essential for assessing long-term durability.
That's a powerful image, the Lollapalooza effect, turning patient experience into a moat. So let's unpack this moat further. In the hyper-competitive pharma industry, you hear about the Red Queen effect, running fast just to stay put. How is Eli Lilly not just running, but seemingly sprinting ahead, widening its lead?
That's an excellent analogy. Lilly is absolutely sprinting ahead, and they're doing it by reinforcing a multi-layered economic moat built on intellectual property, a world-class R&D engine, and overwhelming scale. It's like the Red Queen telling Alice you have to run as fast as you can just to stay in place. That's baseline pharma. Lilly, though, isn't just keeping up. They're strategically widening the distance with every stride. Building advantages that compound makes it harder for anyone to catch up.
And patents are fundamental to this, aren't they? The core protection. So how strong is Lilly's IP fortress?
Patents are indeed the fundamental source of competitive advantage and profitability here. They give that period of market exclusivity, allowing Lilly to recoup massive R&D costs and earn those, supernormal profits. Without that protection, the incentive to invest billions just vanishes. Morningstar explicitly cites patents as a primary pillar of its wide moat rating for Lilly. Grants pricing power, returns far above cost of capital. Lilly's IP estate is extensive. 27 U.S. patents, over 600 international family members protecting key drugs, including Mounjaro and Zepbound, whose core patents extend to at least 2036. That's a long runway for their biggest growth drivers.
But is this passive protection? Or do they actively defend this IP? Got any examples? Because having patents is one thing, enforcing them is another.
Oh, it's anything but passive. Lilly's IP is an actively, aggressively defended fortress. Their long history of patent litigation clearly shows this is a core competency. They know how to maximize the economic life of their innovations. They understand a patent, undefended, is just paper. Take the Alimta case study. Huge legal battle over their lung cancer drug. Lilly successfully defended not just the compound patent, but a later vitamin regimen patent, covered co-administering with vitamins to reduce toxicity. Crucial. Through numerous challenges, US and Europe, Lilly upheld the patent's validity infringement, extended market exclusivity for years until May 2022, protected billions in high-margin revenue from generics. They used sophisticated arguments like the doctrine of equivalence.
So they fight hard.
Relentlessly. And it's not isolated. They consistently leverage the legal system. Cialis, their ED drug, they settled with generics, shortened the patent life a bit, but got certainty and royalty-bearing licenses. Predictable revenue. This goes way back. Prozac, Zyprexa. It's a proactive, formidable stance.
Why is this aggressive legal strategy so critical for your understanding of Lilly's long-term durability? It seems tied to the core business model.
Yeah, if we connect this to the bigger picture, those billions in high-margin revenue, protected and prolonged by legal wins. That's the very lifeblood funding their R&D engine. Without this aggressive, sophisticated legal strategy, their ability to reinvest over $10 billion a year into discovering the next generation of medicines, it would be severely compromised. Patent protection isn't just about current profits. It's about securing resources for future innovation. It drives home the point. A wonderful pharma company must be a brilliant innovator and a formidable legal combatant. Lilly excels at both creating and protecting value.
So patents protect the present, R&D builds the future. What does Lilly's innovation engine actually look like? Is it just big spending, or is there more to it?
This raises an important question. If patents are the fortress walls, R&D is the engine of innovation within that fortress, constantly building. Lilly's commitment is immense, and crucially, it's highly productive. In 2024, they invested nearly $11 billion in R&D. That's about 24% of sales.
24%.
Yeah, remarkable percentage, among the highest in the industry. This sustained reinvestment fuels a pipeline widely seen as one of the very best. Numerous high-potential candidates.
What's in that pipeline?
It's deep and broad, across core areas. In metabolic diseases, they're not resting, advancing next-gen assets like the oral GLP-1 or forglipron aiming for a pill form, and the triple agonist retatrutide targeting GLP-1, GIP, and glucagon promises even greater efficacy. In neuroscience, the anticipated Alzheimer's candidate, donanemab or Kisunla, shown promise in slowing decline. And their oncology pipeline is particularly vast. Dozens of molecules, all phases, targeting many cancers, using cutting-edge stuff like antibody-drug conjugates, ADCs, precision chemo delivery, and KRAS inhibitors for tough cancer.
Oh, and is it all internal, or do they look outside too?
Oh, they actively supplement internal efforts. External innovation is key. Numerous collaborations. Biotech firms, academic institutions, tech companies gives them access to innovative platforms like gene therapy, protein degradation, AI machine learning, and drug discovery. Accelerates things significantly. This open innovation model ensures Lilly stays at the absolute forefront of science and tech, pulling in the best ideas from everywhere.
Beyond patents and R&D, what other intangible assets contribute to Lilly's moat? It sounds like they're building advantages everywhere.
What's truly fascinating here is that the advantages extend well beyond IP and R&D. Lilly benefits immensely from powerful advantages of scale and a trusted brand built over, nearly 150 years now.
Scale, how does that play in?
Manufacturing scale as a competitive weapon. The unprecedented demand for Mounjaro and Zepbound created a potential bottleneck, right? How to make enough. But Lilly made a strategically astute move. Committed over $50 billion since 2020 to a massive global expansion of manufacturing capacity, mostly in the U.S. Huge commitment. This isn't just about meeting demand, it's a profound competitive weapon. By ensuring reliable supply where competitors might face shortages, Lilly captures and defends market share. They're essentially cornering the market on capacity, turning a potential weakness into a significant, durable advantage few can match. Ensures they capture the full economic opportunity for decades.
And a global reach.
Yeah, their global commercial infrastructure. Operations in over 140 countries. That's a formidable global sales and marketing machine, built over decades. Allows rapid, efficient product launches, deep market penetration worldwide. Creates a very high barrier to entry for smaller firms. Lagging global commercialization means is a huge hurdle.
Right.
And finally, brand trust. Founded 1876. Eli Lilly has built this powerful brand, synonymous with quality, scientific rigor, patient focus. That's an incredibly valuable and tangible asset in healthcare. Facilitates adoption of new meds, strengthens relationships across the ecosystem, provides a pre-established credibility newer entrants just don't have. When a Lilly drug comes out, there's inherent confidence.
So it's clear Lilly has built a formidable fortress. But who are the big players in this lucrative metabolic disease space? How does Lilly stack up against rivals? Is it truly a protected market for them, or are others closing in?
Okay, let's unpack this competitive landscape. The primary dynamic today, undoubtedly the duopoly with Novo Nordisk in the massive diabetes and obesity markets. While Novo's semaglutide drugs, Ozempic and Wegovy had a first-mover advantage, Lilly's tirzepatide, Mounjaro, and Zepbound has consistently shown superior efficacy in trials, especially weight loss. Lilly's drugs typically around 21% weight loss, highest dose. Novo's around 15%.
That's a significant difference.
It is. It's a classic two-horse race, but the market is so vast, projected over $100 billion, that both companies can and likely will thrive. But Lilly's superior product profile certainly gives it a powerful edge in capturing new patients and share as supply eases.
How do the sales compare right now?
Well, Q2 2025, Mounjaro and Zepbound combined for $8.58 billion. Shows that aggressive penetration. For comparison, Novo's Wegovy was estimated maybe $1.9 billion that quarter, Ozempic around $4.3 billion. Full year 2024, Mounjaro alone was $11.54 billion, Ozempic $17.45 billion, Wegovy $8.44 billion. Importantly, Lilly's key patents extend to at least 2036, slightly longer runway than Novo's semaglutide, estimated around 2032. That patent longevity is critical.
And how does Lilly's overall strategy compare to other big pharma players?
Well, Pfizer, for instance, strategy is built on broad differentiation. Many therapeutic areas, sometimes cost leadership. Merck relies heavily on Keytruda, their immuno-oncology blockbuster, and leans on acquiring external innovation. Novo Nordisk, as we said, more singularly focused on metabolic disease, helped by their unique foundation ownership structure, allowing long-term focus. Lilly's strategy seems like a powerful synthesis. Deep internal R&D, aggressive external deal-making for strategic gaps, and that decisive large-scale manufacturing build-out, all focused where they can lead.
That distinction is helpful. But with such a massive market, are there any significant emerging threats that could disrupt this duopoly or Lilly's dominance? Success breeds competition, right?
This raises an important question, definitely a focus for long-term investors. The extraordinary success of GLP-1s has inevitably attracted a swarm of new competitors, small biotechs, other large pharma. A key emerging threat comes from smaller, more nimble biotechs like Viking Therapeutics. Their dual GLP-1 GIP agonist, VK2735, has shown very promising clinical data. Weight loss efficacy comparable, maybe even better than initial Lilly data points, potentially favorable tolerability, could launch as early as 2027.
Viking. Okay.
The risk from these emerging players is twofold. First, a smaller player could genuinely develop a best-in-class molecule. Superior efficacy, safety shifts the standard of care, puts pressure on Lilly's premium position. Second, maybe more likely, a large pharma competitor without a strong GLP-1 presence could acquire such a promising smaller player, instantly become a formidable third force.
Like Pfizer, Amgen, maybe?
Exactly. Companies like Amgen, Pfizer, they're actively developing their own treatments too. Lilly's premium stock valuation assumes continued dominance, a relatively clean runway. There's very little room priced in for that kind of competitive disruption without a significant market reaction. The GLP-1 space is still evolving fast.
A wonderful business can still be hampered by poor management, but exceptional management can elevate a good business to greatness. What about Eli Lilly's leadership team? And why should you, our listener, feel comfortable partnering with them for the long haul?
Eli Lilly's management team, led by Chairman and CEO David Wicks, absolutely meets that high standard, acting as true stewards of shareholder capital. They demonstrate rationality, a clear long-term vision, and an undeniable owner-oriented mindset. Precisely the leadership you want at the helm, especially during such rapid growth and strategic importance.
Well, let's talk about David Wicks specifically. His priorities, his philosophy. How's he steering the ship?
Since becoming CEO in 2017, Ricks has been crystal clear. Accelerate innovation, foster a more agile, communicative culture, ensure Lilly stays at the forefront. He recognized the traditional Lilly nice culture, while collaborative, could maybe inhibit productive conflict, speed, bold decision-making needed today.
Right, slow things down sometimes.
Exactly. So he's actively pushed to increase development pace, foster more collaboration, internal and external, maintain that innovative edge. His guiding philosophy: simple, powerful, often articulated as, if it's going to be a great drug, let's make sure it says Lilly on it, encapsulates that drive for leadership, best-in-class products.
And how has he demonstrated a proactive, long-term vision? Pushing beyond norms, maybe taking some controversial steps?
He's certainly shown willingness to push beyond norms for the long-term future and societal standing. One particularly unprecedented move, unilaterally slashing insulin list prices to 35 months for uninsured patients, way ahead of mandates.
That was big news.
Huge, not just PR. A bold, proactive move prioritizing access, goodwill over short-term profit, remarkable for big pharma. Similarly, creating Lilly Direct, the platform for patients to order meds directly in the U.S. Another bold strategic initiative. Improves affordability, streamlines access, and critically, builds direct customer relationships. Bypasses some traditional intermediaries.
Cutting out the middleman, potentially.
Potentially. These actions reflect a leader actively shaping the future environment, not just reacting. Anticipating trends, positioning for long-term success and relevance. He also emphasizes clear shareholder communication, a global view. Articulates core long-term value drivers, innovative meds, pipeline, strong TSR, frames work in broader societal contexts like the 30 by 30 goal for healthcare access in resource-limited settings. Vision is global. Aggressive plans to expand manufacturing internationally, invest billions more for supply chain security for decades. That's real long-term thinking.
The clearest evidence of alignment with shareholders is often compensation and how much skin they have in the game, right?
Yeah.
Their own capital invested. What do we see at Lilly? Why does this matter for you as a potential partner?
Lilly's comp structure and insider ownership are powerful, tangible indicators of that owner-oriented culture. Directly aligns incentives. First, pay for performance. Executive comp is heavily weighted to long-term, performance-based incentives. Annual cash bonuses tied to operational goals, revenue, EPS, pipeline progress. But more importantly, the vast majority of comp comes from multi-year equity awards, contingent on rigorous multi-year metrics.
Like what kind of metrics?
2-year EPS growth relative to peers, 3-year absolute stock price growth, and 3-year relative total shareholder return, TSR, against its peer group. This ensures leadership is rewarded only when long-term shareholder value is genuinely created. Their personal wealth is tied directly to yours. They only win if you win long-term.
And the insider ownership levels.
Exceptional. A powerful testament. As of February 2024, CEO David Ricks held Lilly stock valued at an astounding 199 times his annual base salary.
Wow, 199 times.
Absolutely dwarfs the already significant 12x requirement. Other execs also hold multiples way beyond required levels. Total reported insider ownership of 11.17% is remarkably high for a company of this size, shows deep shared commitment. And furthermore, August 2025, after a stock price dip, Ricks and other senior execs made significant open market purchases.
Buying more shares.
Exactly. Not just symbolic, a clear, confident public signal of their deep belief in future prospects at that valuation, putting their money where their mouths were.
That's a strong signal. So given this owner-oriented mindset, how has management actually deployed capital over the last 5 years? What does their report card look like for your investment? How are they allocating resources?
A thorough review shows a management team that is disciplined, strategic, focused on maximizing long-term per-share value. The report card is, well, excellent. First and best use of capital, reinvesting into the core competitive advantages. As we mentioned, consistently plowing massive amounts, nearly $11 billion in 2024, back into R&D, fuels the innovation, sustains the moat. Funding the pipeline is paramount. They also have a long, disciplined history of using strategic M&A to supplement the pipeline, acquire critical capabilities.
Like the Oncology deal.
Exactly. 2019, transformative for their cancer franchise, brought in innovative targeted therapies. More recent deals, Point Biopharma, radiopharmaceuticals, Versanis Bio, obesity, Dicey Therapeutics, immunology, demonstrates clear strategy, acquiring promising tech and assets in core areas, not just buying for scale or diversifying randomly, targeted tuck-ins, and shareholder returns. Strong, consistent record. Increased dividend 11 consecutive years. Recent annual growth around 15%.
Solid dividend growth.
Yeah, and well covered by earnings, cash flow, payout ratio around 36-44%, healthy, leaves ample capital for reinvestment in those high-return opportunities.
What, in your view, is the single most telling sign of their rational capital allocation?
Yeah.
The thing that truly demonstrates this owner-oriented mindset.
What's truly fascinating and really indicative is the recent dramatic pivot in capital allocation priorities. Share repurchases, a component in prior years, fallen to zero since 2021. They stopped buying back stock.
Zero buybacks.
Zero. Simultaneously, capital expenditure spending on manufacturing plants, physical assets surged more than fourfold, $1.4 billion in 2020 to over $6 billion in the last 12 months.
Huge shift. Why?
It's a direct, supremely intelligent response to the single greatest opportunity in modern company history, the GLP-1 market. Instead of mechanically buying back shares at high valuations to maybe juice short-term EPS, management correctly identified the highest return investment was pouring every available dollar into building tangible, revenue-generating manufacturing assets. To meet that near insatiable demand from Mounjaro and Zepbound,
Investing in the capacity.
exactly. Saw a supply-constrained market, made a massive, decisive bet on capacity. This is the essence of an owner-oriented, long-term mindset. Investing for decades of high-margin revenue capture, not quarters of EPS beats. Prioritizing strategic infrastructure over financial engineering. That's a masterclass in capital allocation.
That's a powerful shift. Finally, how important is company culture in all this? What's it truly like at Lilly? Can culture be a competitive asset?
Culture can absolutely be a powerful, intangible competitive advantage, especially in innovation-driven pharma. At Lilly, it appears to be a net positive. Deeply grounded in a clear, compelling mission, employee reviews consistently highlight the purpose, discover, and bring life-changing medicines to those who need them as primary motivation. This shared mission is invaluable for attracting, retaining world-class scientific, commercial talent needed to succeed. Overall, 72% positive employee reviews. Cite collaborative environment, good work-life balance, high ethical standards, crucial in a regulated industry.
Any downsides to the culture?
Of course, like any huge global organization, it's not perfect. Reviews also mention typical issues. Bureaucracy, sometimes slowing decisions, internal politics, occasional favoritism, predictable fictions of a large enterprise. Represents a key challenge for Ricks as he pushes for agility while maintaining a strong foundation. But the foundational elements of a strong, purpose-driven culture seem firmly in place, provides a solid base reinforcing their ability to innovate and execute long-term.
So we've painted this picture of a truly wonderful company. Exceptional management, powerful moat, impressive culture, surfing a mega trend. But the final, maybe most challenging part for any long-term investor, and for you, is determining a rational price. The market isn't blind to Lilly's strengths. Is there any margin of safety left at current prices, or is it all priced in?
That is indeed the crux of the dilemma. Forces a critical judgment call. The stock trades at a premium, reflecting immense optimism, high expectations. As we approach valuation, let's apply that mental model of inversion. Systematically think through all the ways this could go wrong. Rigorously evaluate key risks inherent even in a business this strong. Helps understand what's not currently priced in.
So what are the current valuation metrics telling us about this premium price? How does it stack up?
As of August 2025, Lilly trades at a trailing 12-month PE ratio around 45x. Based on consensus analyst estimates for 2025 earnings, the forward PE is about 30x.
45 trailing, 30 forward.
Right. Now, these multiples are significantly higher than the broader market, maybe low 20s, and much higher than most large cap pharma peers, typically teens or low 20s, immediately signals the market's assigning a substantial premium for Lilly's perceived growth and quality.
Has Lilly always traded this high? Or is this recent, driven by the Incretin revolution?
It's undergone a dramatic re-rating, especially the last few years. While its 10-year average PE might be skewed high sometimes, for much of the last decade, it traded far more modestly, closer to peers. The current valuation is well above its pre-Incretin revolution norms, clearly indicates the market fully embraced the narrative of Lilly as a premier high-growth story. Perception shifted from solid pharma to generational growth.
What's the prevailing narrative among Wall Street analysts? What does that consensus imply for your expectations if you invest today? What's priced in?
The prevailing view on Wall Street: overwhelmingly positive, almost euphoric. Consensus rating is strong buy. Average 12-month price target near $990. Suggests meaningful upside even from here. But worth noting, the range of targets is quite wide. $650 to $1,190. Reflects significant uncertainty about long-term growth, terminal value in such a fast-evolving market.
Big range.
Yeah. The narrative priced in now is one of near-flawless execution and continued dominance, it assumes. Continued unencumbered market leadership in that $100 billion-plus obesity market. Successful execution of the massive manufacturing expansion, no major hiccups, and a highly productive pipeline reliably delivering the next wave of blockbusters to sustain growth beyond incretins. Any deviation from that flawless execution could be met with a swift, sharp market reaction, little margin for error priced in.
So now for the inversion. What are all the ways this investment could go wrong? What are the primary threats that can fundamentally undermine your investment thesis, even for a company this strong?
Right. By inverting, systematically thinking through pitfalls, we identify key risks that could permanently impair the business, crucial at high valuations. First, patent cliff and concentration risk, the perpetual sword of Damocles for pharma innovators. While Mounjaro's Zepbound patents extend to at least 2036, Lilly's financial health is becoming increasingly concentrated on this single franchise. Morningstar projects nearly two-thirds of sales by 2032 from these drugs.
Two-thirds from one franchise.
Yeah. Means any unforeseen event, long-term safety issue years later, a truly superior competitor, successful patent challenge would have an outsized, devastating impact. Higher concentration equals higher risk from a single point of failure. Second, regulatory and pricing pressure, arguably the most significant external threat. Globally, governments, private payers intensifying efforts to control healthcare costs. Pharma pricing is a primary target. In the U.S., nearly 60% of Lilly's sales, the Inflation Reduction Act introduced Medicare price negotiations. Political rhetoric remains heated.
Always a risk.
Always. CEO Ricks talks about rebalancing pricing, U.S. versus Europe, but it's a fraught process, uncertain outcome. A future political environment with more stringent price controls could permanently impair industry profitability, R&D funding. Directly impacts Lilly's ability to discover the next blockbusters. Third, clinical trial and pipeline risk. Drug development has a notoriously high failure rate. A successful pipeline is fully priced into Lilly stock. Failure is definitely not.
Right. The market expects success now.
Exactly. The sharp negative reaction to the oral GLP-1 or forglipron data, stock fell 14% plus despite a stellar quarter, just because data was seen as maybe less competitive than hoped, shows how sensitive the valuation is to pipeline news. Any significant setback for a late-stage asset, especially one meant to extend metabolic leadership or replace older blockbusters, could lead to swift, severe re-rating. Finally, competitive and execution risk. That duopoly with Novo, not guaranteed forever. Emerging candidates from smaller players like Viking Therapeutics pose a credible long-term threat. If their drug proves best in class or gets acquired by big pharma,
Changes the game.
fundamentally shifts the competitive landscape. Furthermore, Lilly's ambitious manufacturing expansion, monumental undertaking, significant execution risk. Any delays, quality control failures, inability to meet staggering demand could cede critical market share to competitors also racing to scale. It's not just building factories, it's flawless global supply chain management under immense pressure.
So the current valuation presents this paradox for the long-term investor. Qualitative evidence points overwhelmingly to a wonderful company, undeniable moat, exceptional management. Quantitative evidence suggests the market knows this, leaving little, if any, traditional margin of safety. How do you reconcile this for our listener? What does it mean for your conviction?
This truly forces a critical judgment call. Every investor must make it for themselves. Is it better to pay a high price for a truly exceptional business with a historic growth runway, or wait for a fair price that, given the quality, may simply never materialize meaningfully? Buffett and Munger's philosophy evolved on this, right? Later conclusion. Far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Right.
The central question for Lilly, then, is defining fair in this context. Given consensus analyst projections for earnings growth around 30% annually, medium term, the stock's forward PE of 30 implies a price earnings to growth PEG ratio of approximately 1.0.
Pig of one.
Yeah. For a business of this caliber dominant market position, superior ROIC, immense growth runway, leadership in a generational megatrend, a PEG of 1.0 can be credibly argued as a fair price. Suggests the market's paying 1 unit of PE for 1 unit of growth. However, this conclusion is entirely dependent on the company's ability to consistently deliver on those high growth expectations and navigate the significant risks we just discussed.
Big if.
Huge if. The decision to invest today hinges on the conviction that the quality, the moat strength, the sheer scale of the opportunity are so profound that they can overcome the high starting valuation through many years of rapid, durable compounding. The risks are real, significant, mustn't be ignored. But the potential reward owning what could truly be a generational compounding machine at a pivotal moment is equally compelling. It's a high conviction bet on continued excellence, sustained innovation, and flawless execution.
What an incredible deep dive into Eli Lilly. We've truly seen a company that exemplifies a wonderful business, undeniable moat, exceptional leadership, surfing a massive megatrend. But as you heard, that quality, that immense potential, undeniably comes with a price tag that demands near-perfect execution and a very high degree of conviction from investors.
Yeah, it raises an important question for you, our listener, to consider. Considering the significant premium the market has already assigned to Lilly, what specific additional factors would you need to see from their pipeline, future clinical trials, long-term market dominance, to feel truly confident that the current valuation isn't just justified, but still offers an extraordinary long-term compounding opportunity, even if it means foregoing a traditional margin of safety? How do you personally weigh that generational potential against immediate price? And how much conviction does this company inspire in you to make that trade-off?
That's a powerful question to chew on. Really gets to the heart of long-term investing. We hope this deep dive has given you a comprehensive shortcut to being well-informed on Eli Lilly and Company. We'll be back soon with another deep dive into a fascinating company or trend. Until then, keep learning and stay curious.